3M Company, stock ticker MMM, just did something many people thought would never happen. The company sliced its dividend payments, and to put this into perspective, this company was a dividend king. If we look at the dividend history for this company, they had been increasing dividend payments for 65 consecutive years. And to put that into even more perspective, that's actually older than the age of their new CEO, who is 61 years old. So this company had been increasing dividends for a very long time. Now, if you've been watching the channel for a while, a dividend cut for 3M is something I've actually been warning people of for quite some time. I put a video out a few months ago warning people of this. And then I also wrote an article on Seeking Alpha back in February, how a dividend cut was not only needed for 3M, but was likely imminent. And again, you could see this was written in February. Now, when I published this article, I got a lot of really interesting comments. A lot of people seemed confused how a company like 3M, who had been making big dividend payments for 65 consecutive years, could cut their dividend payment, especially after they had just recently hiked their dividend payment by around 1 cent. But what they failed to understand is there is a lot more to take into consideration when looking at the safety of a dividends company than simply the dividend history or the payout ratios. And in the case of 3M, we could see they had a lot going on. They had ongoing lawsuits, high debt levels, slowing free cash flow growth, and a higher than wanted payout ratio. And with their most recent dividend cut, their quarterly dividend payout is now sitting at about 70 cents per share. And we can see this puts their starting dividend yield sitting at about 2.77%. Now, in this video, there's a couple of different things I want to do. Yes, I want to analyze 3M and see if it's trading at a good value, and I want to jump into the recent quarter's earnings report, but I also want to talk about how this 3M dividend cut was predictable and how I saw it coming. So let's go ahead and start digging in. Now, to start breaking this down, I'm actually going to be using a new spreadsheet that I just released over on tickerdata.com. And like always, you can download any of my spreadsheets and also get access to the Ticker Data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet over on tickerdata.com and also get a 7-day free trial. But the idea behind this spreadsheet that I just recently built out is to help automate analyzing the balance sheet and the health of a company. And here's how it works. Let's go ahead and come up here and plug in 3M and hit enter. And you can see all this data is going to automatically load in. And there's plenty of things to break down here. We have some key balance sheet highlights, cash per share, some profitability metrics. But what I really want to talk about is the current ratio over time. And we can see this charted out here. Now, what is current ratio over time? Well, the current ratio is simply when you take a company's total current assets divided by their total current liabilities. And basically what this tells us is how well a company can meet its short-term obligations. And ideally, you want to see the current ratio well above 1 because that would mean a company can easily meet its short-term obligations. And as it gets lower and lower, if it gets to 1 or below 1, the company starts to get in a pretty tricky position. So let's go ahead and look at this current ratio over time for 3M. We can see starting in about 2017, it looks like their current ratio was sitting at about 1.86. I would consider that a pretty healthy range, especially for a company like 3M. We can see in 2018, it was in that range, a little bit of a dip down in 2019, but 2020 jumped all the way back up to 1.89. But look what has happened in the past 3 to 4 years. We see a decline in 2021, see a decline in 2022, and in 2023, it got all the way down to 1.07, meaning that the company's current total assets was barely covering their total current liabilities. Now, some companies can get away with a lower current ratio for a period of time, but here's the problem with 3M. Like I mentioned earlier, they are also facing some major lawsuits. And this is something they talked about in their 2024 earnings presentation. We can see they had an agreement that includes pre-tax present value commitment of up to $10.3 billion payable over 13 years. And then with the Combat Arms earplug settlement, pre-tax present value of $5.3 billion payable over 7 years. And after taxes comes out to around $13 billion. Now let's go ahead and dig into this 3M dividend cut a little bit more. If we jump over to my dividend breakdown spreadsheet, plug in 3M and hit enter, we can see all this data will again load in thanks to Ticker Data. Now, if we come in, we can see, like people were pointing out in the comments of my Seeking Alpha article, yes, a really nice history of increasing dividends for 65 consecutive years. From 2013, they were paying out $2.54, and in 2023, $6.88. That's decent dividend growth during that time period. But look at 2019 to 2023. That dividend growth decreased significantly during this time period. And if we go over to the free cash flow versus dividends paid out, we can see from 2020 to 2023, free cash flow was actually declining while the dividends the company was paying out was increasing. And it got to a point where you can see in 2022, free cash flow was barely covering that dividend payment, and the same was true in around 2023 when they had a free cash flow payout ratio of around 65.37%. So if we come over here, we can see the 5-year free cash flow CAGR for this company was less than 1%. So it's extremely hard for a company to increase their dividend payouts when they're not increasing their free cash flow. So when you combine the fact the current ratio was at an all-time low over the past decade for this company, they're facing lawsuits, free cash cash flow was slowing and the payout ratio was higher than they'd like it became pretty clear that a dividend cut was not only in the works, but was probably in the best interest of 3M. And so with the dividend cut, they're now paying out $2.80 per share. That's barely higher than it was in 2013, and it's actually just a little bit lower than it was in 2015. So to put this in perspective, their yearly dividend payout is going to be somewhere around right here in this range when you compare it to this chart. Now, anytime we have a change to the dividends, whether it's a huge dividend hike or a dividend cut, I want to know how it affects the free cash flow payout ratio. So let's go ahead and scroll down and break this out. Here we can see we have 3M, and I want to know what their current dividend payout is. So again, I'm going to use the ticker data add-on to automatically pull that in. I'm just going to type in dividend here and hit enter. And again, we can see their current dividend payout at $2.80. Now I want to know what their free cash flow per share was as of 2023. So I'm going to select 3M, select free cash flow per share, and type in 2023 and hit enter. And we can see in 2023, 3M's free cash flow per share came in at $9.14. So to find out what their adjusted free cash flow payout ratio will be after the dividend cut, what we can do is we'll take this dividend and divide it by free cash flow per share and hit enter. And we can see based off free cash flow per share in 2023, the free cash flow payout ratio is now all the way down to around 30.62%, which puts them in a much healthier range. Now, don't get me wrong, no investor wants to see a dividend cut, but this was something that was very needed for 3M. So what this dividend cut should do is drastically reduce the amount the company is paying out in dividends every single year. And hopefully what this should allow the company to be able to do is more easily pay off those debts, pay off those lawsuits, and most importantly, reinvest back into the business to get higher free cash flow growth in the future. Now, with all this being said, if we actually look at 3M over the past month, they're up almost 16%. This is one of the best months for the company in a very long time, because keep in mind, if we look at the past 5 years, they're down nearly 40%. And if we look at the latest quarter's earnings report, they actually saw beats on the top and bottom line. We can see Q1 non-GAAP earnings per share of $2.39 was a beat by around 28 cents and adjusted revenue of $7.7 billion, which was flat year over year, but was a beat by around 40 million. So the market seemed to like these results. We can see in the past 5 days, again, up almost 4%, and like I just said, past month up around 16%. And we can see during this earnings report, they also announced they're going to be welcoming Bill Brown, the new CEO, effective May 1st. Now, if we look at the Q1 2024 business segment information coming from their recent earnings report, part of the problem is we're still not seeing a lot of growth in these different segments. If we look at safety and industrial, we can see there was a slight decrease in Q1 2024 from Q1 2023, down by around 1.4%, not necessarily a good sign. If we look at transportation and electronics, we can see this was actually up by around 6.7%, so that's decent growth. But then if we look at healthcare, we can see this was only up around 1%, that's pretty slow growth, and then consumer down by around 3.9%. So again, yes, they did beat expectations, but I'm still hoping to see more growth from this company in the future. Now, with all of this being said, moving forward, is this company trading at a good value? Should we consider buying more shares and adding it to our portfolio? And to answer that, let's go ahead and jump into my stock valuation spreadsheet. You can see I've already plugged in 3M here, so this data is automatically loaded in. Now, the beta for the company is sitting at about 1.04, so you should see slightly more volatility than that of the market, but it's not going to be that much. Now, the first valuation we're going to jump into is going to be Graham's valuation, and this values a company based on the earnings per share and the earnings per share growth they are projected to see. Now, this is kind of a unique situation because they just had the spinoff with Solventum, and then of course they just had the dividend cut, which should allow for more growth in the future. So moving forward, I'm projecting estimated EPS of around 9, a low growth rate projection, but slightly higher than previous estimates due to the dividend cut. But then after dividing by Y, which is the current yield of AAA corporate bonds, we come to an intrinsic value of around $78.42. Moving forward, if we look at our discounted cash flow analysis, basically we're valuing the company based on how much future free cash flow they're projected to produce. And I'm projecting a free cash flow growth rate of around 3% for this company moving forward, which keep in mind is actually slightly higher than they've seen over the past 10 years and the past 5 years. But again, I think that's a good goal for the company. Now, one of the things we have to keep in mind, yes, we add all the free cash flows together and find their present value, add the cash and cash equivalents, but we also have to subtract out total debt. But one of the things we also have to take into consideration is the future lawsuit payments. So I actually bumped up the total debt slightly to adjust for those lawsuit payments. But after I've done that, we can find the equity value, find shares outstanding, and we come to a discounted cash flow price per share of $125.16, a little bit higher than that current trading price. Now, typically the next valuation we look at is the multiples valuation, and we basically look at comparable companies. And basically what we do is we look at companies that are similar in structure, but I don't think there's a lot of great comparables in the case of 3M, so we're not going to use it in this scenario. So that leaves our last valuation, the dividend discount model. But here's the problem. Yes, the company did just have a dividend cut. Typically, you can still value a company based off of that. but we really don't know what management's strategy and approach to the dividend payments and dividend growth will be in the future, so it's pretty hard to project a dividend growth rate in the case of 3M as of right now. And in fact, I think if I projected one, it'd be pretty hard for me to know if it's accurate or not because we just don't know what their approach to that dividend will be. So we're not going to use it in this case. So that gives us the two valuations we used, Grams and the DCF, and the average of those two comes out to $101.79 per share, which is very close to the current trading price for this company. So with a 10% margin of safety, you come to an acceptable buy price of around $91.61. And if we look at how they've traded past year, there have been different opportunities when the company has traded in that price range. Now, with that being said, I still don't personally plan on adding any shares to my personal portfolio, even if it did fall into that 10% margin of safety range. Yes, it does look like the market is happy with the recent earnings report, and they're up around 16% in the past month, but I think there's still a lot of question marks around this business. And in my opinion, there's just more easy to predict, more stable opportunities in the market. So there you go, there's an analysis on 3M and why I was able to predict the dividend cut from this company. Like always, if you'd like to be able to download any of my spreadsheets and also get access to my new spreadsheet, the balance sheet breakdown spreadsheet, and get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description and get a 7-day free trial. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.